too much risk. Like the recession fears are getting louder and louder. So I could see if they don't cut next week, which maybe they don't. I think they will, possibly.
Welcome to Loans Elevated, the podcast that brings you the latest industry news, expert interviews, and insightful discussions that will help you stay ahead in this dynamic market. I'm your host, Broch Lassig, and I've spent years in the trenches of the mortgage industry, helping individuals and businesses navigate the complex landscape of real estate financing.
I'm your co-host, TJ Heidenreich, and together we'll cover a wide range of topics, from business strategies that skyrocket your success to mindset and motivation that fuel your growth.
All right, welcome back to the Loans Elevated podcast. I'm here with my boy, Ryan, and we're going to do our best to avoid doom and gloom this session. I'm sure with Ryan
No
here,
promise.
Yeah, there's definitely no promises.
Yeah.
But this week we are going over our mid-year market update, but it's kind of going to be a broad market update because there's not been anything real significant as far as changes. It's kind of been the status quo. But we want to talk about some details that are important to be mindful of and maybe what we're foreseeing through the end of the year into next year. So
Calm before the storm.
Yeah, well, that's what we said last time, calm before the storm.
Well,
and it still is here.
It still is.
Exactly.
Yeah.
That's what I'm saying. So there's not been a whole lot that's changed. But let's dive in, Ryan, to the first thing, because next week is a pretty pivotal week for the Fed. This is going to be the end of July. So this may come out the same week as the Fed meeting. But the end of July they meet. And then they go on a hiatus for 45 days until the September meeting. What are your thoughts on that? What the decisions are going to be and the implications of that?
Well, we had talked about a potential surprise cut next week in that meeting, but I don't know, today with the PCE report we got, which is their favorite measure of inflation, didn't see the progress that they were wanting to, at least the markets were expecting. So I don't know. I feel like it's going to be the same this
Here's
meeting.
the interesting
They're
thing.
probably going to acknowledge the progress we've seen over the last quarter, which has been really good. So I think we'll get a lot of good statement from the Fed, and it should help the markets, but I don't personally foresee a surprise cut.
Yeah. Here's the interesting thing about that we noticed, and we were talking about this today. We saw PCE inflation come out, and the market, even though it was on the core reading, it was actually higher inflation than the market expected. But the bond market, meaning the mortgage bonds and treasury, 10-year treasury, those rallied. In other words, rates, not in any significant way, but rates technically got better today, despite the fact that inflation was bad. So I kind of feel like the market expectations are so low.
Yeah.
They're setting the bar so low that as long as we get close, the market's like, okay, because all the Fed wants is some certainty that we are getting closer to 2%. Well, we have a 2% handle right now. We're 2.5 approximately. So I think that gives the Fed some confidence. I still personally, we've got a $20 wager on this. I still personally believe that we can see the Fed with a surprise cut in July, so next week. However, my thoughts are this, the other wild card that we have with the Fed rate cuts and what their decisions are, is there are a lot of alarms sounding, not only tons of the stuff we've talked about here on the show, but now there's a lot of talking heads and people that are well respected in the Fed or just in the economy in general that are saying, hey, keeping the Fed funds rate higher for longer at this point
Poses way more risk.
Too much risk. Like the recession fears are getting louder and louder. So I could see if they don't cut next week, which maybe they don't. I think they will, possibly. I think there's a good chance they will. It's worth a $20 bet. But I think the alternative is they may get a little more aggressive in their dialogue on, instead the market's currently expecting a 0.25% rate cut in September. Maybe they shift, instead of cutting in July, maybe they say, hey, as long as everything goes, we're going to cut 50 bips. And maybe they increase what their cuts are going to be moving into the future.
Yeah. Yeah, I can't remember where I saw it. I think it was some article on Yahoo Finance or something like that, or maybe it was on social media. But a lot of investors are anticipating 100% chance of Fed rate cut in September.
Yeah, the general market bets
100%.
are 100% chance in September.
So
but
it's
that's
happening.
a quarter point.
Yeah.
Yeah.
50, that would be nice. We'll see.
Yeah, the 50 bips, that's what I'm saying. I think
Maybe
there's
we'll,
a chance.
maybe we'll call it now.
Things are heating up, and really what Ryan and I wrote down was, and we've said this in different ways over the past couple of years, really, because we've been kind of expecting this for a long time.
Yeah.
But never telling our clients. In fact, we've only been telling our clients to buy, because home prices, even during and through recessions, we've showed graphs on this, continually go up and up and up and up and up. So it's something that we've been recommending. But what we are looking at is, we believe this is like two freight trains heading towards each other. You have the Fed on one side, and you have the economy and a recession, really, on the other side. And the Fed is trying to thread this needle of how do we slow the economy down enough to get rid of inflation, but not down so much that we push the market into a recession, and more importantly, avoid a deep recession. The crazy thing is,
the window they're trying to squeeze into is like almost impossible.
it is
like,
like two freight trains.
You're either going to get
200 miles
one
an
or
hour
the
towards
other. I
each other.
don't know if, I mean, it's almost impossible to pull it off.
Exactly. So we believe the recession freight train will win, despite the Fed's best efforts.
Because they've literally said that they would rather have that than have inflation start to ramp back up again.
That's right.
They've admitted it.
Yeah.
So if anything, they're going to err on the side of recession.
Well, and the crazy thing is, remember the chart that we showed in our last market update? I believe this was in February. If you look at the data, you can Google this too. You look at the implications of the Fed rate cuts and how long it takes them to fully work their way through the economy. It's a really, really long time. Just right now in 2024, we are feeling the full effects of the first rate hikes that the Fed did. I don't even remember when that was. That was like almost 2 years ago.
Yeah.
We're just now feeling the full implication of that today. Like sometime, I think it's about July is when that peaks. Yeah. And they continued hiking for months and months. So those
like consecutive. It was every single meeting they were hiking.
Yeah. Historical. Never have we seen it in the history. This level and velocity of hikes. It's pretty crazy. So it's hitting, we're experiencing things that we've never seen it economically in the past, among many other things that we've not seen economically. So that's an interesting thing. Now, the reason this is important is because if we hit a recession, there will be a flight to quality or a flight to safety, which is investors and banks and your 401k, so on and so forth, starting to park money into bonds. And that, generally speaking, in the world today, as it sits today, still is mortgage bonds in the U.S. and treasury bonds in the U.S. If more money flows in there, rates come down. If rates come down,
as long as the U.S. holds a reserve currency, that's always what will happen.
Yeah. But we're not going to get into conspiracy theories or concerns about anything today. So anyway, any other thoughts you have on Fed rate cuts and this needle they're attempting to thread? Why it matters? Did we make that clear?
Yeah, I think we hit it on the head. Which, I mean, like you just mentioned, if the recession happens, obviously the downside is job recession. I mean, it's not going to be great, but mortgage rates almost always, or just in general, always come down. Borrowing is going to get cheaper. It's going to be better going forward. So,
the result of that, we may have mentioned this on a recent episode, but the result of that is we did a research project over the past 12 months here on our team. There were 600 home buyers in a 12-month period that were qualified to buy a home and chose not to buy, waiting for rates to get lower. So we extrapolated all of those buyers that were not qualified to buy and all those buyers that were qualified and actually took the leap to buy. We took that out of the mix. 600 of them are just waiting on rates to come down. That's 600 buyers right here in the Wasatch Front in Salt Lake, Davis, and Utah County here in Utah, just with our team.
Yeah.
You imagine.
So think of the whole industry and then think of the whole nation.
Yeah, but you just think of this valley, for example, real estate in Utah. Yeah. That means if one team has 600, there are thousands of buyers waiting. And there's only, even though inventory levels have kind of increased, there's not even 10,000 homes available on the market right now.
Well, we've seen blips of inventory go up throughout the last 2 years.
But we haven't even hit 10,000. Or maybe we've hit barely 10,000.
But then it quickly comes back down as soon as we hear good or positive interest rate news and interest rates come down.
And the crazy thing is, the past 2 years, the rates have been, we are the lowest rates have been right now in the past at least year and a half, probably 2 years. Today,
when you think of February and March of this year where rates hit their low, gosh, was it the 2-year low?
I don't remember.
Something
It was
like that. I can't remember
good.
it specifically,
Yeah.
but that's when we got back into a pretty heavy seller's market. Like most homes were multiple offers.
Yeah, it happened quick.
Concessions were gone. It happened overnight. Just like how now inventory's increased overnight.
Pretty crazy.
So got to be ready.
The other thing we wrote down, so let's say the recession doesn't come, which the recession, like I said, will drive lower rates, and we believe that because of lower rates, it will drive higher home prices. But the interesting thing is, let's just say things normalize, and the Fed is able to thread this needle. The odd thing is markets in general, especially as it relates to mortgage markets and mortgage rates and the Treasury market, it's been dislocated in a pretty big way. Capital markets and mortgages have been very weird because there's a lot of prepayment risk, meaning rates have remained elevated because, or buy down costs for a lower rate have remained elevated because mortgage lenders are
They're mitigating future losses. Literally.
Exactly, because they usually bet. In a regular market, mortgage lenders are betting that you're going to keep this mortgage for 5, 6, 7, 8, 9 years. So they can make their money on their margin, on the spread between the cost of their money and the cost of your money that they give you. They can make their profit over a 5 to 7, 8, 9 year period. Whereas right now they're saying, hey, we're probably not going to have this mortgage for longer than a year, maybe 2.
Yeah.
So they're basically just maybe 3 months, right?
Oh, yeah.
So they're charging consumers up front. So there's a lot of dislocation. But what I wanted to say is there's this interesting chart that I've studied and we've talked a lot about, which is the historical spread between mortgage rates and the 10-year Treasury. So this is just an easy thing. You can look at average mortgage rates over history, and you can look at the average or the U.S. the 10-year Treasury rate, the yield on both of these. You can look at those and look at the spread between them. So that means if the 10-year Treasury is sitting at 4, historically that spread would put us at a 1.5% over the 10-year Treasury would be the average mortgage rate. So that spread is 1.5% historically.
Yeah.
Well, today, the 10-year Treasury is at about 4.2 today. A 1.5% spread would be 5.7. Today, we're sitting at probably 6.7.
Yeah.
So if nothing else happens except for the economy and the markets believe, all right, the Fed's done hiking, we're going back into maybe a more normal cycle.
We're going to get
rates improved by 1 point
for almost nothing. Just from normalcy coming back.
Exactly. When we feel some level of certainty. That doesn't even account for the fact that if a recession comes,
it goes nuts. It's very faith-based right now.
Yeah.
The consumers need confidence back. And sometimes elections can play roles in that too. So we have that coming up, which is going to be interesting.
100%. I mean, that always plays a role in it. Politics will play a role in the way all this rolls out for sure, no matter what. I don't care what side of the aisle you sit on, it's playing a role.
So besides the economics, just the confidence alone in the consumers is going to help tremendously.
Mm-hmm. So now dive into, this is something that you brought up a couple weeks ago when we were, or even a few days ago that we were chatting, but why there is some risk in us not seeing and why we haven't yet seen the full benefits of within the bond market of inflation slowing down and the Fed changing their tone. Rates really just haven't improved as much as we had hoped.
Yeah.
The Treasury has something to do with that.
Right. Yeah. Well, the U.S. is in such a deficit, the largest deficit we've been in literally in history. And so...
Alert, here's the doom and gloom.
So the issue with that is it's almost working against each other. So if we're issuing treasuries and there's more hitting the market, the yields are going to go up because they're trying to entice these investors to buy these yields. That's what's going to help mortgage rates come down, is yields dropping. But if we're continuing to issue paper to pay for debts, that's a problem. It's working
so
against
in English,
each other.
Let me just simplify this a little bit. What that means, so, all right, the U.S. economy is in a position where we have a massive deficit. We are in tremendous amounts of debt. And it's a challenge for the U.S. The U.S., frankly, is not collecting enough in tax revenue to pay its bills. So we have to pay our bills with a loan.
So currently no debt ceiling too.
Right, which is it's a topic for another day, but look that up. Debt ceiling is currently suspended right now. But the importance of this is the Treasury, which controls the issuance of government bonds, if you will, which is a promise of the full faith and credit of the U.S. government to pay you back money if you give a loan to the government they'll pay you back with interest based on, like for example, the 10-year is at 4.2% today. They'll pay you 4.2% to loan them money for the next 10 years. It's a very safe bet because is the U.S. government really going to put ourselves in a position where we can't pay the debt? It's highly, 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 highly unlikely. But here's what's happening. They're refunding these treasuries. So before the notes come due, they're now needing to raise money, new money, to make sure that they can capitalize those treasuries that are becoming due. So they're issuing new debt. In other words, they're going to the investors in the marketplace saying, we need your money so that we can pay our bills as the U.S. government. And these are at historic levels today. The challenge and the reason we haven't seen mortgage rates improve, despite the fact that inflation has come down a lot, and many in the industry have been calling for rates to be lower than they are today, is because there is low demand. We have the banking crisis where banks don't want to invest in these bonds because they got stung really, really hard by having too much on their balance sheet. And with what the Fed did, it basically it defaulted several banks, as we remember the bank crisis last year and earlier this year.
Yeah.
But what we're seeing happen is a dilution of demand for U.S. Treasuries, period, worldwide, because China doesn't like us and we've got the whole BRICS
Goes back
thing.
to the confidence.
Exactly. There's less confidence, so the demand is lower, and we now have supply growing through this. So it's unfortunate, but hopefully that made a little bit more sense. I don't know that I simplified it anymore, but Treasury refunding, you could Google this if you're interested. There's a conflict, despite the Fed slowing things down, despite the Fed not selling off all of their treasuries, all their mortgage bonds like they were doing, the Treasury is coming in and flooding the market with the same inventory. So we're not seeing the move that we had hoped for. That's the dislocation in the markets. Hopefully that solves itself as the confidence starts to come back.
Yeah.
Hopefully it does, or we hit a recession one way or the other. I think it either gets better or it gets way worse, which the fear will cause, I think, more interest in U.S. Treasuries. Drive rates down.
Yeah.
So mortgage rates. What do you think our call is on what mortgage rates are going to do from this point forward? We're talking July 2024. What do we think is going to happen?
Man, it's tough to say in the short term. Over the next year, I think with the election settling, you've got the moving pieces in the economy. I think obviously we hit a turn within the next year. Now, I don't know. I think at this point we've changed our mind. I think it could very well be a sudden shift, and we see mortgage rates just drop like that very quickly because we've hit the point where it needs to happen instead of them gradually coming down.
There's a potential of this unexpected cliff, basically.
Yes.
Economically speaking, we could see something change.
But I think
really
come
quick.
September, we could start to see the gradual shift. Who knows? Maybe we start seeing average rates down in mid-sixes, which I can guarantee you that is enough to pull at least double the home buyers we're working with today back into the market.
And I think, based on what we had talked about, whether it's the recession that wins or it's the Fed that wins, one way or the other, I think it's almost a certainty we see rates drop by 1 to 1.5 points.
Yeah.
Just normalization of the spreads and the historical data that we've seen economically throughout history. We see rates improve by 1 to 1.5%. So let's just say that puts us in about the mid-fives. Mid-fives is a ridiculous shift. And the biggest thing, and I think call to action for anyone that's listened throughout this whole thing, us ramble on, the biggest call to action is recognize when that happens, those 600 buyers that we talked about and the thousands and thousands and thousands of others that are sitting on the sidelines, everyone will be racing to get into housing and buy property. And the homes will appreciate at a level this is our bet, but I believe that homes will appreciate at a very unusually high level for a period of time. It will normalize, but I think once that happens, there's so much pent-up demand that we see a 15 to 20% increase in a pretty short period of time. And when you're talking about the average home price somewhere in the 550 to 600 range here in Utah, and if home prices go up 20%, that's $120,000 added to your net worth just because you own a piece of real estate. That doesn't account for tax benefits of owning real estate. That doesn't account for paying the balance down by owning real estate. That doesn't account for potential cash flow if it's a rental property. Just the sheer value of the asset, 120,000 wealth creation.
The crazy thing about that is if you start to see that, let's say that happens, which we obviously fully believe that it will relatively soon. If you're seeing that amongst social media and news headlines, it is too late at that point.
Oh,
it's already
by
started.
far.
If you're trying to play the game of the FOMO purchasing and you start applying and looking into it at that point, it is already too late.
Our
I can
favorite
guarantee
quote
that.
that we constantly reference is the Oracle of Omaha: be fearful when others are greedy, and greedy when others are fearful. Well, there is a lot of fear and a lot of clickbait nonsense all over YouTube, all over social media, all over the large, big media that is housing is scary. Housing, don't buy a house right now. It's a bad time to buy a house, so on and so forth. Well, what's going to happen is everyone's going to be like, oh my gosh, the housing is so great. Look at all this stuff that we're winning. Those are going to be the people that bought in the past 2 years and buy today before this shift happens. Those are going to be the ones singing the tune of like, wow, I just won big. And if you get in at that point, that is when everybody is greedy and excited about it. Now you're going to lose money.
Gosh,
So
eerily similar to right before COVID or as COVID got real.
Yeah.
What, February?
Yeah.
February, March.
everyone's like, oh my gosh, holy crap.
I purchased during that time frame the best move I ever made. And everyone is looking back like, oh, you're lucky. That was great timing. It was debatably the worst time to buy at that time because there was so much
If you
uncertainty.
got advice from anyone, they said, hell no. I bought my lot on the house that I just built at that exact time. It was literally March 17th, 2020.
What was everyone doing? They were buying toilet paper.
Right. And I was like,
they weren't thinking about buying a house.
well, and I called the seller and I'm like, hey, dude, I need an extension. I need a 90-day extension.
Yeah.
Just because it was so uncertain. It was crazy. I was hoping I could rely on COVID. And he's like, oh, yeah, no problem. We'll give you a 30-day extension. You just need $100,000 in hard earnest money. And I'm like, forget it. So my wife and I, we had to make a decision. We're like, are we going to bite this bullet and take this risk? And we did, thankfully, because our lot probably went up 2 to 2.5, 3 times in value with very quick. Probably less than 2 years. Yeah, maybe 2 years at most. So you got to take some risk. It feels scary. But what I can say, I've been in the business a long time, 16 years. I've seen people that were coming out of the Great Recession. I got in 09. So I saw the people that were suffering through the Great Recession. Some sold, some didn't sell. Well, the ones that didn't sell and they persevered through that situation, which was the most difficult real estate market we've ever seen. Come 2012, 2013, they were cashing out hundreds of thousands of dollars in the real estate. And then guess what? They were buying at the bottom, quote unquote, of the market.
Yep.
And then they rode the wave back up. I mean, these people literally became millionaires because they persevered through times when everyone was saying to give up or not buy. They made it happen.
So the worst time ever in history in the real estate market for the next decade or longer, what was it?
Created millionaires.
Yeah, 12 years.
Yeah.
Was the most lucrative time to ever be involved in the game of real estate.
Yep.
And it came from the worst time in history.
And this very well could be a repeat of that same exact thing. I mean, it's crazy to think that house prices could just keep going up like that. But fundamentally, you look at economics and supply and demand, it's like, how could they not?
Well, borrowing gets cheaper.
For sure.
That's all it needs to happen.
Exactly. And it will, basically.
Yeah.
That's what we're saying. So anyway, hopefully that's helpful. That's our market update. I think a lot of information, some stuff you could go Google and research on your own. Call us if you have any questions. If we piqued your interest, we would love to help. But thanks for tuning in and joining us again.
Thank you for tuning in. For more industry insights, follow us on all platforms at Loans Elevated.
And to get in touch with our team, call or text 801-713-4000 or visit loanselevated.com.